It's reasonable to assume that when you're in retirement, you're no longer working and earning an income, so you shouldn't have to pay taxes. But unfortunately, that's not how the IRS works. You typically do pay some kind of taxes in retirement. And that's important because, of course, you've got some fixed income sources and you might be taking money out of retirement accounts. But the more you have to pay in taxes, the less you have left over for spending on everything that's important to you. So in this video, we're going to give you some information to help you not get caught by surprise so that you can budget for what your taxes might be and strategize your spending. And there are also some additional side benefits of keeping your taxes low. It is easy to overdo that, and I don't know that you need to necessarily go to 0% taxes because the price of getting there can be quite high, but knowing a few things can help you take advantage of opportunities that could potentially help you. So we're going to go over types of accounts, and that helps you understand what the tax consequences are, and then you can choose what to spend so that you kind of dial in your tax level as they show with those sliders there. We'll talk about Social Security and pension income, as well as required minimum distributions, or RMDs. So the different types of accounts you have are going to affect the taxation when you take money out. In tax-deferred accounts, those are things like your traditional pre-tax IRA, maybe a rollover IRA, a 401k with pre-tax money. That money has never been taxed, and so it will need to be taxed when you take it out of retirement accounts. So when you're ready to spend it, if you pull out, let's say $25,000, you can't necessarily spend that whole $25,000, or you want to know if you can or not, because you may need to send some of that to the IRS for tax payments. Then we have tax-free accounts. Those are your Roth IRAs, for example, an HSA, a health savings account if you use the money for qualified healthcare expenses. These accounts do not generate taxable income when you take the money out. There are also taxable accounts like your individual or joint brokerage accounts. Those are going to have you paying taxes each year as you earn the income in those accounts, but you might also have gains if the things you invest in gain value. So if you sell those investments, you would typically have maybe long-term or short-term capital gains, taxes that you have to pay on those gains, and typically long-term capital gains are going to be the most favorable for you. Social Security might be taxable or it might not. If it's your only source of income, there's a decent chance that you're not going to pay tax on Social Security income. But if you have other sources of income, including withdrawals from pre-tax retirement accounts, you might have to pay taxes. So I'm going to include some information in the description, a link right to the Social Security Administration's website to help you figure out more about that. Pension income is typically taxable, so if that's from an employer that you worked for, they pay you a lifetime income, that's typically taxable. Then your required minimum distributions are often taxable. The IRS requires you to take money out of tax-deferred accounts, and the idea is to make sure that that money isn't tax protected indefinitely. So they want to generate some tax revenue. In most cases, that's going to be in pre-tax accounts, but there are a couple of exceptions, maybe with inherited accounts, where it's not going to generate a tax bill for you. So how can you manage your taxes? There are a couple of strategies. One is to pull from whichever bucket makes the most sense to pull money out of. So if you're in a year where you have a relatively high income, for example, and you want more money out of your retirement accounts, it might make sense to pull that from a tax-free bucket like a Roth IRA. That way you're not going to further increase your tax bill while you're at a potentially high rate. You can also look at filling the tax brackets, and that means trying to pull out just enough to pay taxes at a relatively low rate. So if you're in a low income year, that's an opportunity to say, I'm okay with this tax rate. I'm going to take out a little bit more money from my pre-tax accounts and go ahead and pay those taxes because I think that that will level out the rate at which I pay. So yes, you are prepaying some taxes, but it can potentially end up in you paying less overall during your lifetime. That's similar to what you're doing with a Roth conversion strategy. With that approach, you convert money instead of actually taking a withdrawal, you shift it from a pre tax account to an after tax Roth account. And there are some tricky rules when you do this, but if done well, it can result in you having money in tax free accounts. And again, typically, ideally, you're paying at a relatively low rate so that you can smooth out those taxes throughout your lifetime. Then there's also the idea of just general tax efficiency. So that's trying to minimize turnover and try not to get too much in short-term capital gains in your taxable accounts. Maybe consider asset location, like what types of investments go into taxable accounts versus tax-sheltered accounts, and other things like that. So if you'd like to talk about these types of things and get some ideas on your retirement, I'd be happy to chat with you. We can go over all of this and much more. And please subscribe to this channel. This helps you stay up to date. It does not cost you anything. And it also helps me out a tiny bit. So thanks for doing that. And thank you to everybody who has already subscribed.